$1.5 million in pre-tax retirement money at age 60 is where the standard advice to max out your 401k can begin to backfire. Under a reasonable set of assumptions, that balance puts your first required withdrawal almost exactly at the line where the 12% federal bracket ends and the 22% bracket begins. Not vaguely close, $65 over the line. That does not mean everyone should stop contributing the moment an account reaches $1.5 million. It means this is the point where autopilot becomes dangerous, because the deduction you love today may no longer be cheaper than the tax waiting for you later. I read the IRS distribution tables, the current tax brackets, the Social Security taxation rules, and the Medicare surcharge tables. The disturbing part is not that the system hides the rules, they're all public. The disturbing part is that the standard retirement advice usually ignores how those rules interact. For decades, maxing out your traditional 401k may have been an excellent decision. You reduced taxable income, invested more money, collected employer matches, and allowed the account to compound without annual tax drag. That advice helped build your wealth. Then the same strategy quietly changed jobs. It stopped being a wealth-building tool and started manufacturing taxable income for your 70s, 80s, and possibly for your children. Nobody sent you a notification when that happened. The traditional 401k is based on a tax trade. The government gives you a deduction at your marginal tax rate today. In exchange, your contributions and their growth are taxed as ordinary income when withdrawn. You win when the tax rate avoided today is higher than the effective marginal rate paid later. If you deduct a contribution at 24% and eventually withdraw it at 12%, the trade is beautiful. If you deduct it at 22% and withdraw it at 22%, the main tax rate advantage has disappeared. If that withdrawal also triggers higher Medicare premiums, state income tax, or a compressed single filer bracket after one spouse dies, the trade can turn negative. The first brain problem appears before any calculation. You can see today's deduction. It appears on your pay stub, tax return, or refund. The future liability does not appear on your 401k statement. Your account shows $2 million, even though part of that balance economically belongs to the government. A $2 million traditional account is not the same asset as a $2 million Roth account. One is a warehouse containing untaxed income. The other can be a pool of qualified tax-free money. The statement balance makes them look identical because retirement platforms are very good at displaying assets and remarkably quiet about displaying the tax claim attached to them. Here is how the $1.5 million threshold is calculated. Assume you are married, age 60, and have $1.5 million in traditional 401k and IRA accounts. Because someone who is 60 in 2026 was born after 1959, current law generally places the required minimum distribution age at 75. People born earlier may start at 73. The age matters enormously because every extra year gives the account more time to grow before the government forces distributions. Use a conservative 2% annual return after inflation. I am using real returns because tax brackets are generally adjusted for inflation. Mixing nominal portfolio growth with today's unadjusted tax brackets would produce a scary number and bad analysis. After 15 years, $1.5 million growing 2% above inflation becomes approximately $2,018,800 in today's purchasing power. IRS publication 590B gives an age 75 distribution divisor of 24.6. Divide the account by that number, and the first required minimum distribution is approximately $82,065. Now add Social Security. Assume the household receives $60,000 a year. At this income level, as much as 85% can be taxable, so roughly $51,000 enters the federal calculation. The required distribution plus taxable Social Security produces approximately $133,065 of ordinary income. The married standard deduction for tax year 2026 is $32,200. Subtract it, and taxable income becomes approximately $100,865. The 12% bracket for a married couple in 2026 ends at $100,800. That is the $65 difference. I am not including temporary senior deductions that expire long before this hypothetical 60-year-old reaches 75. I am also assuming no pension, rental income, interest, part-time work, or withdrawals from another traditional account. Add any of those, and the sweet spot moves lower. This calculation does not predict what Congress will do 15 years from now. It exposes the amount of pre-tax money that already consumes your available space in the lower brackets under current law. Once your existing balance is projected to fill that space, the next traditional contribution is no longer creating a clean tax arbitrage. If you save 22% today and the contribution later emerges in the 22% bracket, you have no rate advantage. You accepted future uncertainty in return for a deduction at the same federal rate. That is the point where the standard advice flips, not when you have enough money to retire, not when your employer stops offering a match. It flips when the projected marginal cost of withdrawing the next pre-tax dollar becomes equal to or greater than the marginal deduction you receive for contributing it. If your current deduction is 24% and your future withdrawal rate is 22%, traditional contributions may still make sense. If your current rate is 12%, while you are temporarily between high-income years, taking a traditional deduction can be a terrible exchange. The correct answer comes from comparing marginal rates, not from declaring that Roth is always good or traditional is always bad. If you appreciate finance that reads the footnotes before making the claim, subscribe. The expensive mistakes are usually hiding in the interaction between two boring rules. Required minimum distributions make this interaction unavoidable. The IRS does not ask whether you need the money. It takes the prior year-end balance, divides it by the applicable life expectancy factor, and creates a minimum amount that must leave the account. At age 75, the divisor of 24.6 produces a withdrawal of a little over 4%. At age 85, the divisor falls to 16, creating a withdrawal of 6.25%. At age 95, the divisor is 8.9, which is more than 11%. The percentage rises as you age. Even if the account stops growing, the government demands an increasingly large share. If your investments continue performing well, the dollar amount can rise despite years of distributions. There is an option to delay the first required distribution until the following April, but that can place two required distributions in the same calendar year. Delaying paperwork is not the same as reducing income. Sometimes it creates the exact bracket spike you are trying to avoid. Now consider what happens if a 60-year-old couple crosses the sweet spot and continues maxing both traditional 401k accounts for another decade. For 2026, the standard employee contribution limit is $24,500. The general catch-up for someone 50 or older is $8,000. Between ages 60 and 63, the higher catch-up is $11,250. Using those current limits in inflation-adjusted dollars, two spouses, beginning at age 60, could contribute a combined $71,500 annually for 4 years, followed by $65,000 annually for another 6 years. That is $676,000 of additional pre-tax contributions. At a 2% real return, those deposits could be worth approximately $819,000 by age 75. That new block of money alone adds more than $33,000 to the first required minimum distribution. It also carries a future federal tax claim. If the couple received deductions at 22%, the 10 years of contributions saved approximately $148,700 of federal income tax when made. If the additional balance is eventually withdrawn at 24%, the federal tax attached to it is approximately $196,600. That comparison does not automatically prove Roth wins. A fair economic comparison must account for when taxes are paid and what happened to the original tax savings. At identical tax rates, traditional and Roth money can produce remarkably similar after-tax outcomes when every dollar is invested consistently. But people rarely invest a separate portfolio containing every dollar of their 401k tax savings. The deduction gets absorbed into monthly spending, a larger house payment, travel, or an ordinary checking account. The account keeps compounding while the supposed offset vanishes. If those additional retirement dollars are eventually exposed to a 32% marginal rate, the federal tax attached to the new balance rises to roughly $262,000. That is more than $113,000 above the deductions originally received at 22%. A 32% future rate is not guaranteed. It becomes plausible when large required distributions collide with a pension, investment income, the death of a spouse, or inherited account rules. The six-figure mistake is not produced by account growth alone. It is produced by building a large balance without preserving enough lower tax years to dismantle it. Medicare adds another layer because its surcharges behave less like smooth tax brackets and more like steps. For 2026, the first Medicare income-related surcharge begins when modified adjusted gross income exceeds $109,000 for an individual or $218,000 for a married couple filing jointly. Crossing the first line adds $81.20 per month to Part B and $14.50 per month to Part D per affected person. That is approximately $1,148 a year for one person, or twice that for a couple. One extra dollar of income can cross the threshold and trigger the entire tier. Medicare usually looks back 2 tax years, so a large distribution or Roth conversion can increase premiums after the tax bill itself has faded from memory. This is why your future marginal rate is not always the number printed beside an IRS bracket. The next withdrawal may be taxed federally, taxed by your state, and responsible for a Medicare surcharge. If Social Security is not yet at the maximum taxable percentage, extraordinary income can also cause more of those benefits to become taxable. The official term for the Social Security interaction is less memorable than what it does. A retirement account withdrawal adds $1 of ordinary income while potentially pulling more Social Security into the taxable column. Your effective marginal rate can therefore exceed the statutory bracket. Then one spouse dies. This is the part most retirement calculators soften with a neat life expectancy assumption. The surviving spouse can inherit most of the retirement assets, but eventually lose the ability to file jointly. One Social Security payment usually disappears, yet the traditional account and its required distributions may remain substantial. Under the 2026 brackets, the married standard deduction is $32,200. The single deduction is $16,100. The 24% bracket begins above $211,400 of taxable income for a married couple. For a single filer, it begins above $105,700. The first Medicare surcharge line also falls from $218,000 of modified adjusted gross income for a couple to $109,000 for an individual. The surviving spouse does not need the same household income to encounter the same tax pressure. The thresholds have been compressed before the retirement account has had time to shrink. This is sometimes called the widow's penalty, although the code applies regardless of which spouse survives. A couple may look perfectly safe while filing jointly at 75, then discover that the survivor is paying a higher marginal rate and Medicare surcharge on withdrawals from the same pool of money. Planning as though both spouses will use joint brackets for 30 years is not optimism. It is a broken model. Your children can inherit the problem too. Many non-spouse beneficiaries must empty an inherited traditional retirement account by the end of the 10th year after the owner's death. Depending on the original owner's status, annual distributions may also apply during that window. Those withdrawals can land during the beneficiary's peak earning years. A traditional account that gave you a 22% deduction can be withdrawn by an adult child paying 32, 35, or 37%. Leaving a large account is generous. Leaving an account with a compressed tax deadline is a more complicated gift. This is the mainstream financial betrayal moment, although it is less dramatic than a conspiracy. The advice to max your 401k was built for accumulation. Most retirement marketing celebrates the largest possible balance, because a large balance is easy to measure, easy to display, and often profitable to manage. It does not show what percentage is spendable. It does not model the survivor's return. It rarely combines required distributions, Social Security taxation, Medicare premiums, state taxes, and inherited account deadlines. The 4% rule has a similar blind spot. 4% withdrawn from a Roth account is spendable money. 4% withdrawn from a traditional account is gross income before taxes and possible premium effects. The same withdrawal rate can finance 2 very different lifestyles. Your actual sweet spot is therefore not a magic account balance. It is your remaining retirement tax capacity. Start with the highest taxable income level you are willing to reach. That may be the top of a federal bracket, the Medicare surcharge threshold, or a lower number chosen to leave room for capital gains and Roth conversions. Add the deduction you expect to receive. Then subtract taxable Social Security, pensions, interest, rental income, and any other income likely to fill that space. The remainder is the required distribution your chosen tax ceiling can absorb. Multiply that allowable distribution by the IRS divisor for your starting age. The result is the maximum pre-tax balance that fits beneath the ceiling when required distributions begin. Project that number backward to your current age using a reasonable return after inflation. Then subtract the future value of any planned employer contributions. What remains is the amount of pre-tax money you can add before crossing your chosen line. That is the sweet spot calculation. The $1.5 million example is one output for a married 60-year-old household receiving $60,000 of Social Security, earning 2% above inflation, carrying no pension, and trying to preserve the 12% bracket at age 75. Change the assumptions and the answer changes. A pension moves the line lower. Delaying Social Security can create conversion room before required distributions begin. Retiring earlier gives you more low-income years. A higher expected return lowers the amount you need today to create the same future balance. A state without income tax changes one component but does nothing to federal brackets or Medicare. Knowing these numbers and building a system around them are two different things. That gap is why I built a digital book called The Exit Code. It is an analysis of 50 years of retirement data distilled into a mathematical framework for exiting the rat race without pretending one withdrawal rate works in every market or tax environment. It explains the 4% trap and the dynamic withdrawal method that replaces rigid spending with rules based on portfolio conditions. It also shows how tax diversification turns future withdrawals into decisions rather than forced income, and how to convert a vague retirement goal into a specific date supported by the numbers. You can get it for less than a dinner out through the link in the description. Every year you postpone this planning adds another year of growth to the accounts you have the least control over. The useful question now is where your next savings dollar should go. Reaching the sweet spot does not mean you stop saving, and it does not mean abandoning the employer match. A match can represent an immediate return of 50 or 100% on part of your contribution. Future taxes rarely erase an advantage that large. Contribute enough to capture the full match. The decision begins with dollars above that level. If your employer offers a Roth 401k, you can direct some or all of your employee deferrals there without the income limits that apply to direct Roth IRA contributions. Roth and pre-tax employee contributions share the same annual limit, so changing the tax treatment does not require changing the savings habit. You pay income tax now. Qualified withdrawals can be tax-free after the applicable age and 5-year requirements are satisfied. Under current law, designated Roth workplace accounts are no longer subject to lifetime required minimum distributions for the original owner. Your plan may also offer Roth treatment for employer matching contributions, although this is optional and creates current taxable income. Read the plan document rather than assuming the payroll website exposes every feature clearly. Roth is especially attractive when your current marginal rate is lower than the rate projected for retirement. It can also be valuable when rates are close because you are buying control. A Roth withdrawal does not add ordinary income to your return, which can help fund a car, roof, vacation, or family gift without crossing a Medicare line. Paying 24% today to avoid 12% later would be a bad trade made in the name of diversification. Tax flexibility is valuable, but there is no prize for prepaying tax at an obviously higher rate. The second destination is an HSA if you are eligible. In 2026, the contribution limit is $4,400 for self-only coverage and $8,750 for family coverage. Someone 55 or older can add a $1,000 catch-up contribution with separate account rules applying when both spouses qualify. An HSA can provide a deduction when money enters tax-deferred growth and tax-free withdrawals for qualified medical expenses. After age 65, non-medical withdrawals avoid the additional penalty and are taxed much like traditional retirement distributions, while qualified medical withdrawals remain tax-free. That makes the HSA unusually flexible. Healthcare is one of the few retirement expenses you can predict will exist, even when the amount is uncertain. Saving receipts can also preserve the ability to reimburse yourself years later under current rules, provided the expense occurred after the account was established and was not reimbursed elsewhere. The third destination is a taxable brokerage account. It receives no deduction, which is why deduction-addicted investors treat it as inferior. In retirement, its lack of special treatment becomes a form of freedom. There are no required minimum distributions, contribution limits, or retirement age withdrawal rules. When you sell, your original cost basis is not taxed again. Long-term gains can receive lower rates than ordinary retirement income. For 2026, the 0% federal long-term capital gains range extends to $98,900 of taxable income for a married couple filing jointly. Capital gains stack on top of other income, so the opportunity depends on the rest of your return. But a low-income retirement year can allow gains to be realized at little or no federal tax. A taxable account can also fund the years between leaving work and claiming Social Security. Those gap years are often the best opportunity to convert selected amounts from traditional accounts to Roth. Instead of waiting for the IRS to choose your withdrawal schedule, you choose how much ordinary income to create. You can fill a lower bracket without spilling into the next one, pay conversion taxes from taxable assets, and reduce the balance exposed to future required distributions. The goal is not to convert everything. A giant conversion can create the same bracket and Medicare damage you were trying to prevent. Conversions work best as a sequence of measured decisions, not a ceremonial transfer followed by an enormous tax bill. Market declines can create useful conversion opportunities because the same tax payment can move more shares into Roth at depressed prices. Recovery then occurs inside the tax-free account. That advantage must be balanced against cash needs and portfolio risk. A tax move is not helpful if it forces you to sell essential assets at the wrong time. Charitably inclined retirees have another tool after age 70 and a half. A qualified charitable distribution made directly from an eligible IRA to a qualified charity can satisfy part or all of a required minimum distribution while excluding that amount from taxable income, subject to the applicable rules and annual limit. That can be more effective than taking the distribution, reporting the income, and hoping an itemized deduction repairs the damage. A qualified charitable distribution is not a solution for money you need to spend, but it can prevent charitable giving from inflating adjusted gross income unnecessarily. If this is the kind of tax math you want before the bill arrives, subscribe. Retirement becomes far easier when your accounts give you choices instead of deadlines. You do not need equal amounts in traditional Roth and taxable accounts. A perfect 1/3 split is another rule invented because round fractions sound intelligent. You need enough accessible, taxable money to finance planned gap years and conversion taxes. You need enough Roth money to cover irregular spending without creating unwanted income. You need enough traditional money to benefit from deductions and fill lower retirement brackets without overwhelming them. Run the calculation annually during your final working years. Update the current balance, expected retirement date, Social Security estimate, pension, filing status, state, and planned contributions. Test one spouse surviving, test stronger returns. Test whether a required distribution crosses a Medicare threshold by a few $1,000s. Then compare the tax rate saved on the next contribution with the all-in marginal cost projected for its withdrawal. When the future number is higher, redirect the contribution. When today's number is clearly higher, keep using the deduction. When they are close, favor the account that gives you more control over reported income. The most expensive error is not choosing traditional instead of Roth in one isolated year. It is allowing every retirement dollar to accumulate under the same tax rules until the government controls the timing. Lazy investing built more fortune than crypto memes. But lazy tax planning can hand a painful share of that fortune back to the government. The most important move in your final working years may be the moment you stop chasing today's deduction and start buying tomorrow's control.